Thank you so very much for joining us today. I have John Rubino with us, one of America's thought leaders, someone who thinks into the future, puts things together in a very understandable fashion, and gives you some just absolutely outstanding advice as to what you can do, protect your family, protect your wealth, protect your portfolio. And we have some really incredible times coming us, and we are so fortunate to have John Rubino with us. Let me bring John on with us. John, thank you so very much for coming up with us today. We're recording now, and I want to thank you so much for coming. A couple of questions. Let's start off with one. Let's talk about interest rates. So interest rates are actually going up. The Fed is cutting them down, and the long-term rates are going up. What's your thoughts on something like that?
Hey, Michael, that's not something that usually happens. Usually when the Fed starts to ease by cutting short-term interest rates, long-term interest rates fall too, because they assume that the Fed is going to force interest rates down across the board. This time it's not happening. The Fed cut rates reasonably aggressively, 50 basis points in September. And then since that day, the 10-year Treasury note yield has been going up. So that means the bond market is not listening to the Federal Reserve. When the bond market loses confidence in the central bank, that's usually a very bad sign for the currency and the economy as a whole. So what is probably going to flow from this is that the Fed is going to have to get aggressive to push interest rates at the long end of the yield curve down, and it'll do that through quantitative easing, which they used last time around, where they create new currency out of thin air, use that to buy long-term bonds, and force the price of the bond down, which also force the price of the bond up, which pulls the interest rate down. And if they don't do it, the reason I think they're definitely going to do it is because if they don't do it, our over-leveraged economy is just going to tank, because so many different sectors of the economy require low interest rates to function. And obviously, real estate, your field, is chief among them. If you don't have a falling mortgage rate, then nobody can buy a house at today's prices. And that means U.S. house prices have to fall hard, which is really deflationary and contractionary. It leads to a recession when that happens. In commercial real estate, tons of apartment buildings and office buildings have to be refinanced after being built with very cheap money in the previous decade. And if interest rates are high, that makes it impossible for these buildings to generate the cash flow that they need to be solvent, and a lot of them get dumped on the market at big losses, and that leads to a bank crisis because local and regional banks own a lot of that paper, and so on. High interest rates are really dangerous to an economy that is this indebted. And the Fed knows that, so they're going to have to force interest rates down one way or another, which what that leads to, right?
Well, John, I think you and I are both on the same page. I think we've already entered into recession. It would be kind of interesting to see this rates going up. Let me go to the slide and let's just illustrate what you're talking about, because we got this sent out. So this is what you're talking about. Can you explain the slide just a little bit for everyone that's watching?
Yeah, this is the yield on the 10-year Treasury note, and you see it fell during September in anticipation of the Fed starting to cut interest rates. Then the Fed did cut interest rates, and look what happened. The 10-year Treasury yield started going back up again, and it has continued to rise till today. It's up again today, so its rise is continuing, and it's not at its cyclical high yet, but it's heading that direction. And the reason this is an important interest rate is because lots of other interest rates key off of it. For instance, mortgages, 30-year fixed rate mortgages key off of the 10-year Treasury yield rate. And what that means is that mortgage rates are going back up again after falling a little bit for a while. Excuse me. Car loans.
And you know what else went up with this? So we have been watching, I've been following you, and you've been talking about how the miners are going to do really well, how gold is going to do. So when they cut the interest rates, the precious metals seems like they just took off. Is there a correlation between what we're looking at and seeing gold and silver go up?
Well, yeah, when a central bank starts easing monetary policy, that's usually inflationary, at least, and also low interest rates help gold and silver because you don't gold and silver then don't have to compete with high yielding fixed income things like CDs and treasury bonds. So normally falling interest rates, at least when they're falling kind of hard, can be good for gold and silver. And the idea now that the Fed was going to start reflating the system, in other words, cutting interest rates and shoving a lot of cash back into the financial system, kind of lit a fire under gold because that might be inflationary. We might go back to 2022 inflation levels that were like
Wow.
8.5% efficient,
Wow.
maybe 15% in real terms. And in that kind of an environment, you definitely want inflation hedges like gold and silver. So people have been buying them like crazy. And another aspect of precious metals is that the world's central banks have been buying a lot of gold. And that's for a couple of reasons. One is that the BRICS countries, who are meeting today as we speak, want to be able to bypass the dollar, and they're considering setting up a gold-backed currency. And their central banks have been buying gold in anticipation of that. And that's another thing that's pushed the price of gold up. So you get a lot of factors right now that make precious metals look really interesting as an investment because higher inflation, a new gold-backed currency that competes with the dollar, things like that are generally really good for the gold price. And we seem to be possibly heading back in that direction.
Well, it also looks at the point, how can we pay this kind of a interest rates on these things for the government? So if you think that we're going to be looking at lower interest rates, what's the strategy for this? So, we kind of have a jeopardy on my time models are saying that prices are out of whack. So my model is completing. We don't have a demand problem in the housing industry. We have an affordability problem. We have just tons and tons of people would love to buy a property. They just can't afford it. And if what you're saying is that you think that the Federal Reserve is going to have to come in and get aggressive, then we probably have a third wave of inflation coming. Is that correct?
Yeah, well, in housing, affordability has two components. What is the price of the house and how much do you have to borrow to buy the house? So when mortgage rates go up, other things being equal, that makes houses less affordable. And since today's prices are insanely high relative to Americans' incomes, houses are already unaffordable before you even think about the mortgage rate. But combine, an unaffordable house price with a really high mortgage rate, and the average American can't come close to buying the average American house. And that's, that happens in some way in most cycles. And usually what happens is, to resolve it is that a huge deluge of inventory comes onto the market. In other words, people start trying to sell their houses for whatever, and they start cutting prices to get the deal done. And that causes prices to plunge. And then that slows the economy down and interest rates come down. And then you get lower house prices and lower mortgage rates, which make houses affordable again. And the cycle begins again, and we're at the very peak of a cycle right now where house prices are crazy expensive and mortgage rates are very high. So we need that inventory to come in. People have to start panic selling their houses. And we're seeing the beginning of that now, right? You look on Zillow and there's a lot of price cuts. And
Correct.
So that's the start of the process. And then the panic comes when all the Airbnb guys can't make a go of it and start dumping their inventory, and the hedge funds and private equity guys who bought up entire neighborhoods in the last cycle find out that they're going to go broke unless they get out from under all the debts they took on to buy those houses, that kind of thing. And then boomers, guys our age will start selling their McMansions because they can't get up and down the stairs. Combine those three things, and you get a tsunami of inventory coming onto the market, which push prices down. And that's very possibly what's coming.
Well, it shows on our model, and of course, homes are sold on the margin. In other words, so the last one sets the price. So if you get someone, as you're talking about, that lost their job, and now they want to sell their house, they've got some pretty big equity in it. They want to capture that equity because they need it. And by the way, this is an aside. We're starting to see people go into their 401ks, their IRAs, and now they're really tapping into their HELOCs because all of the credit cards, you've probably seen all the charts, the credit cards are absolutely maxed out. And that we've got savings being depleted. So people are going into the next assets that they have, and that's their home equity lines. Those are being tapped. And now, John, you're not going to, this is really terrible, is that we're seeing people go into their retirement accounts and taking money out. That is just a foreboding for exactly what you're saying. So what should someone do, John?
Well, the savings rate is really an important part of this story. Mm-hmm. Because if we have a lot of extra money, if we're packing it, putting away half of our paycheck, then we can afford to do things and buy things and borrow things, and we're in the opposite situation now with Americans' savings rate going negative. In other
Mm-hmm.
words, like you said, we're not putting any money away. On the contrary, we're borrowing in some ways that are going to come back to bite us. We're racking up credit card debt. We're tapping our savings plans, and that always ends badly. That's another cyclical thing where people run out of savings, they borrow too much money, and then they stop spending. And so you get a recession because the U.S. economy is not driven by real estate, it's driven by consumption. 70% of the U.S. economy is consumer spending. And when that dries up, the economy, by definition, rolls over, and we get a really nasty recession. So we're heading for a time when all of the things that normally cause recessions are happening at once. Real mm-hmm. estate is rolling over and heading into a downturn. Consumers have no money left to buy things, and so they're not going to buy things going forward. And then there's other things like the big toy index is something people talk about a lot of times. When RV prices are nice and high and sales are high and people are buying boats and buying jet skis, that usually means the economy is growing because people have enough extra money that they can buy frivolous big toys like that. And when those big things roll over and their sales start to drop and their prices start to drop, that's usually a recession signal. And that's happening big time right now. Zero Hedge has a story just today about Polaris, I think is the name of the company. They make jet skis and I want to say boats, but I'm not sure. But anyhow,
their sales vehicles too. They're big on the utility vehicles that they use on the trails.
That's right. That was the other thing. Yeah, they make jet skis and 4x4s, right?
Right.
And four-wheelers, whatever the term is for those things. And their sales are tanking right now. And the same thing with the RV makers. They're not selling RVs. Yeah. And what that means is that people no longer have the optimism or the credits to be able to buy big toys. And they're starting to sell the toys they bought in the happier part of this cycle. And so you got a lot of extra inventory coming on the market, no new buyers for new versions of those things, and their prices tank. Those companies go into big downturns where they lose money and their stocks tank and everything. And that is recessionary. So wherever you look, there are things going on that point towards a recession in the not too distant future. And I would say watch those interest rates more than anything else, but also check out, the sales trends in RVs and the savings rate and stuff like that. All of it right now is pointing down, and things won't get better until they bottom and start pointing up.
Well, it looks like all the discretionary equity and income that people have has been tapped. So if you're in like the entertainment business or the travel business, or I'm expecting that you're going to start seeing cruise lines start really advertising to, try and get people to come onto their ships, because it looks to me that people have spent all of their money. So what should someone do? So what you and I are talking about, we're seeing interest rates go up, which means that the really smart money is thinking, what, John? What are they thinking when interest rates on long term starts going up?
Well, they're thinking they don't want to lend money at today's interest rates, because that's what you're doing when you buy a bond. You're lending money to the issuer of that bond. So with a treasury bond, you're lending money to the U.S. government, in effect. And if you think that you're going to be able to get a better deal for your money a year from now, in other words, if interest rates are going to go up in the coming year, or if inflation is going to spike. Either way, you want a higher return on your lending, and you don't want to lend at today's interest rates. So interest rates have to go up to entice you to buy those bonds. In other words, to lend money to the government. And so that's what's happening in the bond market right now. People are saying, nah, I need a higher yield before I'm going to own a 10-year treasury.
Well, so we've got this turbulent time, John. What should someone do? Because typically when you see interest rates go up, you're either just got this really hot economy, or you've got inflation coming. Is that not correct?
Yeah. When interest rates start going up like that, and traditionally, when interest rates start to go up and lots of recessionary things start happening in the economy, what you want to do is go to cash as much as possible. Sell your assets that fluctuate with the state of the economy, and have a lot of cash. Buy some gold and silver with some of that cash in anticipation of the Fed panicking and easing interest rates aggressively at the same time inflation is going up. And, if you're reasonably sophisticated and risk tolerant, short this market, because normally a recession brings with it an equities bear market, sometimes a brutal one. And watch that movie, The Big Short, for how that went in the previous recession. In 2006, 2007, the housing market was a bubble, and a handful of money managers saw that and bet against it in a big way. In other words, they shorted the market, specifically the housing part of the market. They made life-changing money. One guy, a guy named John Paulson, made $20 billion himself.
That changed your life.
The company that he owned did that, yeah. And so, life-changing money was made by some of these guys who became household names in the financial community. And we could have all done the same thing. There's lots of ways to short the market in anticipation of a downturn. You don't want to do that with all your money, but 5% or 10% of your investable capital could go into shorts. And if they don't work out, you didn't lose life-changing money. But if they do work out, you possibly made life-changing money. And something called put options, especially long-term put options, are really good for stuff like that. You can make a reasonably cheap bet on, for instance, the NASDAQ, where all the tech stocks are. That'll last for 2 years, and so you have plenty of time in which to be right. So,
John, that is such great advice. Can people get hold of you? Can you just maybe say where we can get? I'll put it on the YouTube channel as well. But can you say, because people don't get a chance to listen to an analyst like yourself every single day. I mean, who can hear this? What you just told them was just like, holy cow, who's going to tell them stuff like that? Where can they get hold of this, John?
Well, I publish a newsletter on Substack, and it's at rubino.substack.com. And it's basically aimed at looking for actionable advice for what's coming. In other words, okay, all this crazy stuff is kind of baked into the cake now. How do we protect ourselves or make a lot of money from it so we can protect our friends and our family? And it turns out there's a lot of answers to those questions, and a nice little community is kind of springing up around the newsletter of people who are, looking for the same answers that I'm looking for.
Well, not to put words in your mouth, I just want to recap this a little bit, because we're in such a volatile time. We've got all the indications that recession is coming, and if it's not here. I think you and I think it's here. It's probably been here for a while. My work says we entered into it the fourth quarter of 2023. What's that famous saying? How'd you go bankrupt? Slowly, then all at once. I think that's how recessions work too. Slowly, then all at once. And looking at what we're looking at here, we're seeing people, their credit cards are tapped out. It looks like they're depleting their savings. We're starting to see them going to their home equity lines of credit. We're starting to see them go into their 401ks and their retirement accounts. You just brought up Polaris, which is a toy manufacturer. I mean, when you get plenty of liquidity and equity, you go out and have some fun. And these guys like travel trailers and RVs and 4x4s and jet skis, they're just struggling. And yet we see long-term interest rates. So it seems to me like it's going to be some kind of a timing model here, John. It's you got a recession coming. Great advice to go to cash so that when we do have some opportunities, we have cash to do that. But what kind of time frame do you think you're looking at here, John, and that this is going to happen?
Well, I've been predicting a recession for like 3 years now. So my credibility when it comes to what's going to happen in the next 6 months is virtually zero. So, my answer to that, which I think it's happening soon, but I have for the last 3 years. So don't listen to me on the timing, but do look into the indicators that we talked about and see what they're saying. And if they flash even more red from here, then that means the time is closer when the things that those indicators are pointing towards are coming. So
what kind of signpost do you think they should be looking at, John?
Well, if stocks start to fall in a steady way, if interest rates go up much from here, the system can't handle interest rates higher than today's, and it can't even handle today's.
No.
So if interest rates keep going up, that brings us closer to a breaking point, and we don't know what that breaking point is, but we know we're approaching it as rates go further up into really dangerous territory. Those are the ones you should probably pay most attention to. Just watch interest rates and watch earnings of companies that sell things that aren't necessary. And Polaris is one. The big RV makers, the guys who make big expensive pickup trucks. Most of the car companies now get a lot of their money from pickup trucks, which are very expensive, very high margin, and don't sell very well during recessions. So things like that. Just pay attention to the indicators that we talked about today, and if they continue in this direction, then you're getting close, and you can start placing your bets.
So the best thing to be is try and get yourself liquid, get some cash put up, be as conservative as you possibly can at this juncture, I'm going to guess.
You can start doing that now, placing the aggressive bets on a downturn. I don't know about the timing for that, but by all means, be raising cash right now. By the way, a good indicator of whether you should have cash or not is Warren Buffett's cash pile. He's one of the most successful investors in the world. And historically, when he can't find any more bargains out there in the stock market, he starts raising cash. And when his cash level gets to a high point, that usually precedes a recession pretty closely. Now he has more cash than ever before. His cash pile is vastly bigger than it's ever been, which is a pretty good indicator that we should be raising cash too.
He's been selling Bank of America pretty aggressively as well. So it talks about another sector. By the way, let me just tell you that my model peaked in June of 2022. So that's like 2.5 years. You and I are on the same page. With a recession, we knew it was coming. It's just, and that's when you start getting cautious. So let me just recap. So probably can start accumulating some gold and precious metals for themselves for a nice inflation hedge for themselves, raise cash as much as they can. I would imagine to quit spending if you can, huh?
Yeah, this is a time to be frugal. In other words, of course, I just bought a pickup truck lately, but I did it with my eyes open. If it's at all possible to not spend money on something, then don't spend it. Save as much as you can going into this, because that cash, first of all, it'll protect you, because a lot of people lose their jobs in recessions. So if you're at risk financially in any way, you want some cash sitting there to get you through it. But by all means, be careful in whatever way it's possible for you now, because this is one of those really high risk environments based on history, based on the place we are in a lot of different charts. This is a time when the people who really don't deserve to be hurt end up being hurt because they didn't make the policies, they didn't cause the recession, but they're the victims of it. So you don't want to be one of those victims.
Well, yeah. So you don't need to be invested 100% of your portfolio 100% of the time. There is times to start thinking I want to be a little conservative, and if I lose a little bit of profit, okay, lose a little bit of profit. Better lose some profit than to lose your portfolio. So, and John, I've been taking an awful lot of your time for this. Is there any last thing that you'd like to say to recap this up?
No, we've covered things pretty well. Again, I'll do a plug though. I'm at rubino.substack.com, and in fact, I just did an article today called Recession Watch, which looked at a lot of the indicators that point towards a recession. So that's free, and you can tune in and take a look at it and see if it's helpful.
Well, anytime they can get the type of information that you're bringing, it's just marvelous. Thank you very much for doing that, John. And thank you so very, very much today for coming and meeting us. I appreciate everything that you do for you. My very, very best to you. Thank you much.
Thanks, Michael. Talk to you soon.
Bye-bye now.